Okay, let's look at effective and equivalent annual interest rates on mortgage. Okay, so let's just learn by example here. So the example is the nominal rate on Cedric's mortgage is 6% per year, compounded semi-annually, because mortgage rates are compounded semi-annually here in Canada. He has an outstanding balance of $350,000. There are 20 years remaining on his amortization schedule. How much is Cedric's mortgage How much is Cedric's mortgage payment at the end of each month? So let's calculate his monthly mortgage payment. So the step one to this problem is to convert the nominal rate to an effective annual rate, right? To account for inflation and all that. So in order to convert this nominal rate, which is 6%, to an effective annual rate using this calculator, first let's clear it on second function alpha 0. So you do 2, because it's compounded, the interest is compounded semi-annually, so twice a year. So 2, the XY button, 6%, and then you do second function, and it's the PV button or the EFF button. So the answer is 6.09%. So 6.09% is the effective annual rate adjusted for semi-annual compounding. And now we convert the the effective annual rate to an equivalent annual rate because he is paying it monthly. So we're changing this, or we're calculating the monthly value of this percent. So we clear. Now we have 12 because he's paying it monthly, so 12 times a year, XY, and the interest rate is 6.09% because we just calculated that, 6.09. And we do second function and the PMT button, or this arrow ARP. So the answer is 5.93. So 5.93 is the equivalent annual rate of his insurance. So now we can solve for the payment that he's going to make each month using the TVM equations. So here we go. So let's just, the PV, present value of the mortgage, is $350,000. Okay, so that's where that value comes from. And then interest is 5.93 divided by 12 because it's 5.93%. We just calculated that. And divided by 12 because it is paid monthly. The time period is 20 years times 12 months because it's paid monthly. So 20 times 12, because there's 20 years remaining. And the future value is 0 because he wants to know how much it will cost him each month to pay it off in 20 years. So let's go ahead and calculate it. And again, it is second function alpha 0 to clear the calculator. So here we go. 350,000 present value, 5.93 divided by 12, interest, 20 times 12 is the time period. Future value is 0 because he wants it all paid off. And so what are his monthly payments in order to do that? Compute PMT. So it is $2,493. So the answer to this question is Cedric's monthly mortgage payment will be $2,493, assuming he carries a nominal interest rate of 6%, and after adjusting for the frequency of compounding, which is semi-annually, and the frequency, which is what we calculated here, and the frequency of cash flow, which is what we calculated in step 2, which is the monthly payment. Okay, so his monthly payment is $2,493 for the next 20 years, assuming everything stays the same.